smiling about it.
Is this on?
Oh yeah.
Are we rolling? Okay, welcome to April 12th. Today we're doing a quick market highlight because I don't want to talk about it because it's not interesting at all. That's negative, I apologize, but that's the way I feel. So this is going to be a very fast video. I never did this before. Let's stop talking about it. Here we go. Okay. Today is April 12th, as I just said. Today, the big secret is if you follow any goddamn realtors on Instagram, you've seen in their stories that the Bank of Canada has held. I think most people, at least I did a poll yesterday, only 50 people contributed. Thank you very much to those 50 people. But of those 50 people, my top 50 followers, naturally, 72% of you felt that they were going to hold, so you were correct, and congratulations on that. There are no prizes.
I think that most people in the world will find you disappointing.
Yeah, I think the climate right now is that is expected. I don't know how much digging people do beyond just looking what those numbers are, or if everyone knows and understands what those mean, but anyway, that's what it is. So today, the market update. The market update today, which we haven't done in a while, for good reason, is interesting. So I'm going to go back to the start of the year. If we look at the numbers from, so listing numbers first, because it's less exciting, but more needed, I feel. Listings bottomed December. That was it. I feel that as the rates continue to hold, which I do believe, and I'll jump into some other key hidden messages that the big man gave us in his delivery of said rate speech today. My belief is that we are off the bottom now, which we are, and that we will stay off. I do think they will hold for the year. But anyway, December was the bottom of listings, and it's kind of been in the right trajectory since. And for listing numbers, if I can find it here, condos, January to February, actually we lost 5% of inventory, but then February to March, we're up 37% in listings. So that's collective West Side condos. That's the fastest moving last month. Houses, January to February, we increased 15%, and then February to March, we increased another 20%. So collectively, the housing has got the most activity behind it on both listing and sales. And then townhouses were flat. Quite surprising with that transitional product type. Now, as we go to sales, which is kind of what's motivating sellers on the other side of the fence, give or take what they're competing against, sales bottomed in January, specifically for condos, but housing sales bottomed and townhome sales bottomed in December, like with listings. So with those numbers, it's a little bit different. Condos are the most active, as we're seeing, of course, lower numbers when there's so much weight on everyone's shoulders in the form of interest rates still at record highs. The biggest churn is at the bottom end of the market, which is quite common anyway, but not surprising at all right now considering the rate environment still. So condo sales, January to February, West Side again, that's all we're going to talk about from now until the end of time, is January to February, 45% increase in condo sales. February to March, another 51% increase in sales. So when sellers are looking at this, buyers, they're saying stuff's leaving the market, now there's more inventory, so these actual numbers, not percentages, but number of transactions is going to rise, and all the good stuff is going to get picked off the top. There's a market there to meet this welcomed inventory and throw their expensive money at it and get it off the market because they think the trajectory is moving as they would be correct in that up and to the right, as they call it. So huge sales numbers for condos. January to February, housing was balanced. February to March, housing was up 45% as well, sales-wise. So sales are very strong. Again, I'm not going to compare to last year because it's a totally different market and it's kind of the comparison is irrelevant, but I feel month over month, if you're looking right now, that's the heat you're going to feel. And the heat, if you are looking to buy, is not behind you, is behind you, not in front of you. It's harder now. So act quickly, don't be shy, don't test the market. We went into an offer last night on $1 million 2-bedroom on the west side, and within half an hour of us getting our offer in, we were then in multiple offers. So it's happening. We've had to adjust, and I'm now sitting here with fingers, toes crossed under the table, hoping we get that. But still with subjects, one, but and the competing offer was with the subject as well. So it's not fully as bad as it has been, but it's definitely picking up. So if you're a seller, depending what your prime time is, you're now getting up into that realm of, I think you can benefit on the selling side, and then you're going to be feeling that heat on the buying side when you go back in. So again, townhome sales on the west side, flat. I don't know why that inventory, just no one cares anymore. I guess it's all this development that started last year that's finishing up and they're saturated. But even again, the listings are not moving up at all on townhomes. So I don't know. I don't have these answers. Now, point number 2, the rates. Actually, no, not yet. First, I'm going to go into a little bit more detail here, just for some fun insight. The busiest market percentage-wise on the west side last month was Kits at a 65% absorption, 20 listings, 13 sales. That's detached housing. The second busiest by way of percentage was Arbutus, 18 homes listed, 11 sales, 61% absorption, which is huge. And the third is Mount Pleasant, 33%, but again, 3 listings, 1 sale. Not big data points, but interesting nonetheless. And then the sales ratio the number of sales on the west side, the highest was in the $3.5 to $4 million range, which was 16 sales last month in that window at a 35% absorption. So stuff's happening. General, overall, all price points on the west side. You've got 476 listings last month, 95 sales, a 20% absorption. So we're right at seller's market collective. Now, that's done. Last but not least, the rates, which you've all heard. Rates have been held. Now, some of the talk from him was that rates will not drop this year, which a lot of people, after all that stuff going on in the US, Silicon Valley Bank and Signature and all these other banks that were kind of collapsing and having issues and then getting backstopped and getting too big to failed, if you will, the taxpayers just shoveling them out. A lot of people thought that that would hopefully roll up here. I don't know if hopeful is the right word, but would come up here. Currently, the most shorted bank in the world is TD Bank for a variety of reasons. So people may be hoping that something happen. Obviously, a lot of people hoping that or assuming something's going to happen there. But on the ground here, words from Bank of Canada are that the rates will stay unchanged, at least at this point, until the end of the year. They're not going to come down, which isn't really surprising if you think about it. They're not going to do such a ramping up so quickly and then dump it right back down. They're going to hold it because, as we've talked about, those rates take 6 to 18 months to kind of filter into the economy at scale. It's not just you when you go to the bank and try and borrow money for a mortgage or a line of credit or equity off your home that you're getting hit. They wanted that to kind of integrate, of course, into the economy beyond that. And some of their points here were quite interesting that show just that. Wage growth needs to moderate, which was very interesting. You always talk about strong jobs, we want strong jobs, and now they're saying that income, you're making too much money. Companies are paying their employees too much, and that needs to be moderated, dissipated, if you will. Labor market's still above maximum sustainable employment. Labor markets still above maximum sustainable employment. Unemployment rate has to move up for inflation to come down. So you're getting paid too much, too many of you are employed. We need some unemployment so we can get the rates down from that jobs perspective. As we know, the whole spectrum that keeps moving, that they keep changing, there's the CPI basket, which is a forever changing equation, obviously to benefit them in their narrative. Just my 2 cents of negativity, but there's also all other aspects involved in the inflation, from GDP, the CPI, and obviously employment, gas, blah, 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 blah. So again, let me repeat those. Labor market still above maximum sustainable employment, and unemployment has to move up for inflation to come down. So they're highlighting where they feel we've got sensitivities in keeping inflation sticky where it is and not moving down. Although with that being said, they're expected to be at 3% by the end of 2023, and they are expected or hoping to be at 2% by the end of 2024. And if I can quickly, while having you all stay here and not leave, hold on. May 10th. May 10th is the next April 2023 CPI data is scheduled to be released on May 10th, 2023, 8:30 a.m. So May 10th, we will know if the rate does in fact continue to drop. As we know, we topped out at 8.1 and we are now 6.4. And that top out was June, and we've kind of come consistently down since then. So hopefully we continue. That is all. I'm gonna leave it at that. That was longer than I thought it would be. So it's heating up. If you're buying, be proactive and get out there. Don't expect prices to come down in the short term because the trajectory is against you if you are buying. Sellers, try not to be too arrogant as usual and get things sold appropriately and on time. And next week, that's it. Thank you.